Hi, friends. Welcome back to Kids 2 Grown-Ups Finance. Have you ever heard of something called a bond? It might sound like something you see in a spy movie, but in the world of money, it's a super simple idea. Think of a bond as a piece of paper that says, "I owe you money." When you buy a bond, you are lending your money to a company or a government. They promise to pay you back your original money at a specific time in the future, and along the way, they pay you a little bit of extra cash just for letting them borrow it. That little bit of extra money they pay you is called the yield. You can think of it as your reward for being a lender. The yield is what you get back on your investment each year. Now, here's the most important and slightly tricky part. The price of a bond and its yield are like two kids on a seesaw. When one goes up, the other goes down. Imagine you have a bond where the company promises to pay you $5 every year on your $100 loan. That's a 5% yield. Now, imagine a bunch of people really want to buy this bond. They start offering more money for it, say $110. The bond's price has gone up. But the person who buys it for $110 is still only getting a $5 payment. That $5 payment is now a smaller reward for the $110 they paid. The yield has gone down. On the other hand, if not many people want your bond, you might have to sell it for $90. The price has gone down. But the person who buys it for $90 is still getting that same $5 payment. Now that $5 is a bigger reward for what they paid. The yield has gone up. Now let's discuss about bonds' two key numbers. First is the face value. The bond's face value is the amount the bond issuer agrees to pay at maturity. The face value of a bond is important even though the bond's market price can change. No matter what price you bought the bond for, higher or lower than face value, the issuer will repay the face value at maturity. Let's take an example. A $1,000 face value bond will pay $1,000 when it matures, whether you bought it for $950 or $1,050. When people trade bonds, they often quote prices as a percentage of face value. For example, the bond is trading at 105 means 105% of face value, or $1,050. Second key term is coupon rate. It is the fixed annual interest rate paid by the bond's issuer. It is determined at the time the bond is issued based on prevailing market interest rates and the bond's face value. It is expressed as a percentage of the bond's face value. For example, a bond with a 6% coupon rate and a $1,000 face value pays $60 in annual interest. Now, let's look at the key difference between yield and coupon rate. Yield is based on the bond's current market price, unlike coupon rate, which is on face value. It can be calculated by dividing the annual coupon payment by the current market price. The price of a bond changes because of something big, and that is overall interest rates in the world. Let's consider scenario 1. Market interest rates go up. Imagine today a new government bond is issued, but this time it offers a new higher coupon rate of 8%. Everyone wants the new 8% bond. Who wants your old 5% bond? To convince someone to buy your old 5% bond, you have to sell it for a lower price. You might sell it for $900. The person who buys it still gets that same $50 a year. But now, they're getting a $50 return on a $900 investment, which gives them a higher yield. The price went down, and the yield went up. Now in scenario 2, market interest rates go down. Now let's say a new government bond is issued with a lower coupon rate of just 3%. All of a sudden, your old 5% bond looks amazing. It's paying more than all the new bonds. Because your bond is in high demand, people will be willing to pay more for it. You might sell it for $1,100. The buyer is still getting that same $50 a year, but now they're getting it on a $1,100 investment. Their yield is lower. The price went up and the yield went down. And that's bonds and yields in simple terms for you. If this helps, don't forget to like and subscribe for more simple money lessons.